this is a ticking time bomb. That this is a really, really bad situation. Allow private entrepreneurs to set the level, and then actually the kind of the £22 level goes out the window because the market dictates where the real price of that externality is.
Hello and welcome to Free the Power, the IEA series exploring market-based solutions to the UK's energy challenges with leading thinkers in the field. I'm joined today by Nicholas Leighton-Hall, energy consultant and author of the Marginal Cost of Everything SubStack. Most recently, Nicholas has been writing about the UK emissions trading scheme and how we can make better use of it and understand it. So Nicholas, UK ETS, what's it all about?
Well, when we kind of talk about this, so we're going to be talking about carbon allowances today. And there's a lot of jargon in the field. So you've got carbon credits, you've got carbon offsets. We're talking about carbon allowances today. In its simplest form, it is the right to produce carbon dioxide. So specifically, one UK allowance, as we'll be talking about in reference to this, is the right to produce a tonne of carbon dioxide. Now, we get into a whole kind of murky area of kind of Pigouvian taxes, because that's what this is.
So just before we get there, so
yeah,
who's producing the carbon dioxide? So I had a can of Coke earlier, and I'm pretty sure that it was fizzing with carbon dioxide. Did I pay for a carbon allowance when I bought that?
It will have ended up in the price. I think the cleaner way of looking at it would probably be to say if you had applied some fertilizer to your lawn and you bought that from, say, Ineos Group or some subsidiary of Ineos Group, the carbon dioxide they have produced in the manufacture of that, they have had to pay for. They've had to buy the carbon allowances for the amount of carbon dioxide they've produced, and therefore they will add that onto the price of your fertilizer.
So it's industry fundamentally that are paying for it.
Industry, aviation, and kind of energy generators as well, where there's a fossil fuel component to it.
You mentioned, before I interrupted you, Pigouvian taxes. Could you explain a little bit more about what those are and why they're relevant to this issue?
Yeah, I mean, this goes back to Pigou. I'm sure I've pronounced that incorrectly, but so apologies to him. But yeah, this is economics 101 type of stuff. And the idea being that, the producer of an externality pays for it. If that specifically a negative externality, that they basically pay for it.
So the social cost that's not captured in a normal market transaction.
That's the idea, exactly. And this comes to the kind of core tenets and, the core kind of underlying debate around this, which is what is the cost of carbon dioxide, and therefore who should shoulder the pain or the cost of essentially that negative externality, and let's kind of extrapolate that out to potential kind of implications from climate change. Let's say, an increase in flood defenses, whatever you want to ascribe that cost to in the future. This is a way of essentially making sure that the person who produces the bad thing has to pay for it. That is the Pigouvian tax. And so when we reference this in particular, what this is kind of, it's a market construct for something that otherwise could be centrally planned. The idea being that you allow the market to have some component of price discovery and work out where the market thinks the right level is for people to pay for producing carbon dioxide. So all of this is great if it works really efficiently. What we're going to kind of get to is that maybe it isn't entirely efficient in the UK, and maybe there are some kind of structural deficits and weaknesses that leave the UK particularly vulnerable as a result.
It's a really obvious question, but why should we care about efficiency in carbon markets, given the climate crisis, we're all doomed? So does it really matter if we do this efficiently? Couldn't we just spend a lot of money? It'd still be a good thing.
It depends what are you solving for? This is kind of the crux of the debate when it comes to net zero, the pace of decarbonization. It's, do you look at it as a single variable problem whereby we have one planet and carbon dioxide is bad and there is no price that you can put on that, and therefore the speed at which you decarbonize is the only thing that matters. So if you play with that framing of the problem, then yes, 100%, just let it go to whatever price you need. Let's go as quick as possible. The problem is that it's actually a multivariable problem. Like, because you do need to consider what are the economic effects of doing it. Take just yesterday, the Climate Change Committee, there were 3 of them up with the Environmental Audit Committee, and they have to acknowledge it is part of the CCC's mandate to consider economic costs to the consumer as well. So you can't just solve purely for CO2. So the idea of having an efficient market mechanism, at least, is that you come up with the most efficient solution, which kind of carries both problems of cost to the consumer and also decarbonising.
So therefore freeing up resources to do other things.
Exactly.
So the UK ETS then, have the government pulled off this amazing trick of creating an efficient carbon market?
Well, the answer is unfortunately not. There are a few things that really kind of, I think, need to point out, but I think it's probably worth just kind of going one step back, just so people understand, what is it? How does it work? So look, there are a couple of things that I think is worth people knowing about. The first thing to note is that the government sets the supply. So this isn't kind of like crude oil or general commodities where private companies can go and dig, and they can get whatever they want out of the soil, and then as long as they can do that in economic value, there is a market for that product. The supply is set by the government. Indeed, between 2021 and 2030, it's mandated that 936 million tons of CO2 can be emitted, which was a 30% reduction, which kind of came in to align the emission trading scheme more generally with the net zero targets that they had. So when you kind of think about it in that respect, this isn't actually, we've already kind of blown the idea that this is a free market because the supply is centrally planned. So it's already not an entirely free market in that regard. The other things to note are that it isn't a free price mechanism. So it's called a cap and trade mechanism. And basically, they've capped the supply and, you can trade within it. But also what they kind of, that name fails to kind of measure is the fact that there is a minimum price. So it can't trade at any price. There is an auction reserve price, which is around £22. It can't trade below that, essentially. So you have flawed the market. So you have said definitively that we think the cost of this externality is at a basic minimum £22. On the top side, so you have a very explicit floor. On the top side, you've kind of got an implicit cap on it in terms of the price, at least. And that's because you have something called the cost containment mechanism. And what that does is it looks at the price in the secondary market and says if it has been more than 3 times the rolling 2-year average for 6 consecutive months, then the mechanism kicks in. But all that actually says is that they can choose to increase the supply of allowances or they can choose not to.
So this means the government is controlling the supply and constraining the price or the range of prices.
Yes.
And presume they're doing that because they worry that too high a price will kill lots of industry very quickly and too low a price will insufficiently incentivize people to invest in low carbon alternatives.
100%. Yeah. So that's why quite frankly, the cap is implicit, because there's a softly approach to that, because ultimately if in many respects, kind of the route to decarbonisation, if people actively price the CO2 very high, then in many ways that encourages alternative technologies. That's not necessarily a bad thing. But if the cost is very low, then that is a bad thing for them. I think one of the things that actually is not contained in the blog, but I think is very pertinent on this point, is that we see an awful lot of headlines around carbon capture, around 20 billion, which is going to be spent on these technologies. The chief use case, an economic case for business for carbon capture, is to avoid having to buy carbon allowances. So there's a whole market there, which really only exists because of a government-created, essentially, inefficiency. And then when you have what is a capitalist economy and in many areas kind of free market, when that kind of combines with government, people shuffle around the chess pieces to match whatever inefficiency is there. But that's ultimately what they're doing. And so you sell to companies and you say to them, look, this is, this is a solution because of the inefficiency created by, in this case, the carbon allowance scheme.
So you said earlier that people like fertilizer manufacturers were buying these. Are there other entities buying up these allowances?
This is a crucial point. And I can both understand, but also kind of have some frustration in this. So, and this comes to my own background previously before getting into the space of working in banking myself. I kind of have some idea of how things work. And the process of distributing these allowances happens via auction. So you have an auction every 2 weeks, all through the year. The government sets a supply of allowances for the year, and then it's equally split into auctions throughout the course of the year. In terms of intermediating, in terms of providing some market liquidity, at least in principle, it's not just airlines, chemical manufacturers, and energy producers, so the industrial complex who are doing this. Banks, brokers, hedge funds. If you have MiFID authorization, then you are eligible to participate in this market.
So MiFID authorization being?
Well, hedge funds.
Okay. So a regulation that permits certain people to interact with the market, but not others.
Yeah.
Yeah.
Okay, so
I can't go out tomorrow and buy a carbon certificate of this market.
No, you can't. But I would be interested to know if there is, and this is not something I've explored, but in principle, there's no reason why there couldn't be a carbon allowances ETF that I could go and invest in potentially. And someone who can trade in the market could potentially be going in there and buying them up, and I could actively profit from the performance of UK allowance if they were to go up in price. But that's speculation, so I haven't shut down. But
yeah, it sounds, another analogy, I guess, it sounds a little bit like a sort of crypto carbon, some sort of virtual token to represent something that isn't in any way substantially real, other than the rules that create it and your trust in those rules.
I think that's a fair way of framing it. There obviously are differences, but I think there's definitely some logic in that. Where I think it gets a bit difficult, therefore, and this is something that has happened for a couple of reasons. So one of them being obviously that they have reduced the overall supply by 30%. The other one being that since Brexit, so the EU ETS has been in place since 2005. The UK was a part of this, and then kind of spinning out post-Brexit became the UK ETS. Obviously, what we've done by, there's no fungibility between UK allowances and EU allowances. What that means is the supply has also massively dropped as a result of that. You have a less liquid pool. And this is kind of where we're getting into that. This is the most important bit. Because you've done that, you've got a very small supply of carbon allowances. And you've got players in the market, banks, brokers, intermediaries, and hedge funds, who have very deep pockets. And at the auction reserve price in, between 2028 and 2030, you're talking about needing at a minimum 530 to 470 million across those 3 years. And then on the top side, which is if we take the 4-year average strike, which is around £54 per metric ton of CO2, you're talking around 1.3, 1.2 billion, which, yes, it's a big number, but these numbers are tiny in financial market terms. The UK government last week had a 20-year auction and issued 3.2 billion in just one auction. There will be another 70 this year. These aren't big numbers in financial market terms. So what's to stop hedge fund A, bank or broker, whoever decides that they want to do it, to go in and buy a lot of UK allowances up now and then just hold on to them for a bit? There's nothing to stop them from doing that.
So they don't deteriorate from year to year?
No.
Once you've bought it, it's only when you emit the carbon you actually expend the allowance?
Exactly that. Yeah. You've got, if you are company X, like let's say in INEOS, just in this example, you do produce carbon dioxide, you will need to show allowances against it. If you don't, you will get £100 per metric ton of CO2. You'll get that as a fine, £100 for each one that you haven't basically displayed an allowance for. So you have to do it. But if you're a hedge fund, you don't have any allowances that you need to essentially offset, against your CO2 emissions, you can just sit on it. It won't expire. It's not like buying, it's not like buying a pork belly or kind of anything, like that. It won't expire. You can sit on it. The only way it becomes worthless is if we have completely gone net zero, and therefore there is no market for carbon dioxide because no one's producing it.
So just to be clear then, the advantage of the hedge funder is that they can corner the market. Someone like the fertilizer or chemical manufacturer needs to buy the allowances, and if the hedge fund is offering those allowances at less than the fine, then they would be foolish not to buy them, even if it would be been higher than the market price had they bid and competed earlier. So that sounds like quite a good deal. So what are we doing sitting here? Why aren't we going down to get MiFID registered and investing all our money in them?
Well, this is it. I mean, it is. I think there are many times, and I do want to make this abundantly clear, is like there are lots of good things within energy policy. There are also lots of bad things within energy policy. This is one of those where I looked at it and I did just kind of go, this is a ticking time bomb. This is a really, really bad situation. And something needs to, quite frankly, something needs to be done about this, because you've created a structural fragility for all UK industry as a result of this. And it kind of goes a little bit further, and this is where you kind of get into that. It almost kind of feels a bit pernicious. One of the big things that the government has kind of done, and with Ofgem, so, all the designers and everyone else, what they've said is Clean Power 2030. Clean Power 2030 is that by 2030, less than 5% of electricity generation should be from fossil fuel sources, which is an overlay. Mm-hmm. If you can do that in a way that isn't, increasing prices, then fantastic. If you can do that in an efficient manner, then brilliant. But obviously, one of the implications of this is that a gas-powered electricity generator, so they will obviously have to pay for any carbon dioxide they produce. So last year, for example, it was around £37.5 per metric ton. That's added £18 per megawatt hour onto any gas-generated electricity. Now, if we kind of take this to, and there's a chance of kind of going slightly dipping into hyperbole, so I'm aware of that, but let's just take a conservative estimate and go around, well, the cost containment mechanism is around 3 times as much as the underlying price at any one time. So even if let's say we started the auction reserve, you can see a world where we can get to 66. And indeed, to your point earlier on, the only real top side is £100, because that's where the fine is. That is the level. If you were to triple the cost of a carbon allowance, we're talking, instead of £18, we're talking 54. Actually, it wouldn't be, because you'd kind of tip to 100, but you're talking around £50 per megawatt hour additionally added on to the cost of basically producing electricity via a gas generator. Clearly, gas is going to be no factor in the market at that point. You can, if you start adding £50 upwards of cost onto it,
just from one tax.
Just from this, and this is before we get into any kind of other subsidies or any other punitive elements that there are within the market, you implicitly price it out. But you've not priced it out because necessarily the alternatives are very cheap. And when we talk about baseload energy, which I think is really important, I think like sorry, just to go back a step, but when we talk about baseload energy, which is essentially, that is what gas is in this regard, the alternative being nuclear. We look at Hinkley, which is, is going to be £92.5 per megawatt hour, but also linked to CPI, which is another bug. Bear in mind that everything is linked to CPI.
That was a 2012 or earlier price.
Yep, 2012 was flooring on that. So it's, that won't be cheap. It's not cheap electricity. Nuclear, because of the various hurdles and regulatory issues, is not a cheap source of electricity for the UK. But if you add £50 per megawatt hour onto all gas, then nuclear looks okay in this regard. Like nuclear looks better. Biomass looks better, even though biomass Drax is around £150.
But relatively, because neither have actually got cheaper.
No, your electricity has actually got more expensive, but you've endogenously created an environment in which you've gone to Clean Power 2030, and you've got there because you made gas prohibitively expensive and that.
So the villains in this piece, just to clarify, the government has artificially constrained supply by reducing the number of allowances and by making it impossible to make the system fungible with the EU. But it's introduced barriers to entry and barriers to trade. The hedge funds then rationally responded to these incentives by trying to corner the markets, thereby creating even further artificial scarcity, leaving poor old industry, including the energy generation industry dependent on gas, reliant on these very expensive tokens in order to do their job, which is keeping the lights on and heat in our homes and power to industry.
Yes.
And unsurprisingly, the UK, even though after a few years of operation of this scheme and others, has ended up with some of the most expensive industrial power prices in the world.
Yes.
And you're saying it's going to get a lot worse.
I would say this component of it will get worse. I don't think you can read that across to all energy policy. It's just this particular bit of it can almost certainly get worse. But like all these things, that doesn't mean that there are solutions. There are things that you can do, quite frankly. I think it's really important when we look at these problems, kind of a policy of Luddism towards energy policy isn't a policy. I think you have to come up with credible alternatives. And I think in this scenario, kind of like you have to look at what is the inefficiency that has been created here and think, what are the solutions? So like the government will look at this, and they are looking at this. And, there is, it's contained within the blog, a recent piece by The Telegraph talking about the UK potentially rejoining the EU emissions trading scheme, because that's one way to reduce the supply scarcity as to come back. Now, there are obviously a myriad of other issues with that, which I'm not even going to try and touch on today, but, kind of pros and cons either way. And I say I'll leave that to other people to argue over. But, that is obviously one solution. The other solution is, quite frankly, you relax the constraint. So you can relax the supply restriction. We're kind of seeing government edging a bit that way as well, with some of the kind of loosening of EV targets and, electric vehicle targets. There's a little bit of loosening on that, so potentially you see a bit of loosening in that regard as well. The other thing as well, of course, is that let's let the market decide. And let's not let the government be a monopolistic supplier of the allowances. So what do you get into? So I brought it up right at the beginning. You have credits, you have offsets, you have allowances. Carbon offsets if you gave them fungibility with allowances, then you allow private entrepreneurs, etc., to kind of say, listen, we've planted 1,000 trees and here's this carbon offset to what we have here, and we can source it, we can prove it, blah, blah, blah. Would you like that for £30 instead of paying £60 for a carbon allowance? Yeah, fantastic. That's great. Now, I think that would be the most elegant and probably efficient solution.
Let me just, let me just challenge you for a second. So the whole point of having this scheme of reducing allowances is to create investor certainty, whether we're talking about the certainty for those having to pay for it or for alternative sources trying to replace them.
Yeah.
The minute political reality bites, what we're saying is that the government will reduce that certainty. So flood the market with more allowances, potentially rejoin the EU scheme.
Yep.
So it's not really there at all, is it? It's political certainty in its most traditional form, which is not there at all. And wouldn't the government on that basis be better off with a simpler system, which is just a straightforward carbon tax where the level of the tax is just political?
The problem with that, I would say, is that regardless of the inefficiencies within a carbon allowances market, I still believe that's a better solution than a centrally planned tax, because you are at least allowing some notion of price discovery within all of this. Even though it's heavily constrained, you still have price discovery in a way that you don't with a centrally mandated, centrally planned tax. And if it is set at the wrong level, then those externalities are kind of born to wear, as it were. It's a similar argument to the one that you hear about, gas is setting the price of electricity in the balancing mechanism. And gas being that because it is the last thing to come online. And people go, this is an outrage. So all of our electricity prices have been set because of gas and set at this high level. And it's to which the answer is, well, yes, but what is the alternative to that? The alternative to that is a government mandated price. Do we really think that government and people in Whitehall or people at DESNZ are going to make a better decision than the hundreds and, quite frankly, thousands now, because of the diversification of the LNG system in this kind of renewables world? Are they going to make a better decision? Are they going to come up with a more efficient solution than that mechanism? And I would posit no.
I think, I don't have a fixed view on this, but I do think it's interesting that the two alternatives essentially being offered there are distrusting government to set a carbon tax and distrusting government to set a range of possible prices within an artificial market mechanism.
Again, I think a really, really important point on this is that if you relax the constraints of a monopoly supplier, then you are going to produce a more elegant and efficient result than you would otherwise, which is why I do think carbon offsets make a lot of sense. Allow private entrepreneurs to set the level, and then actually the kind of the £22 level goes out the window because the market dictates where the real price of that externality is. You will give as much price information and you remove some of the distortion that's potentially baked into the market right now. So I do think that is a more elegant solution to it than kind of the structure that we have in place at the moment.
To market solutions to market problems. Thank you. So thank you, everybody, and I hope you enjoyed this episode. And if you want us to make more of them, please subscribe to the IEA YouTube and Substack, and also sign up directly to receive the marginal cost of everything at Nicholas's Substack, the details of which will be in the show notes. Thank you.